Let me be very clear from the start. I don't fall in love with stocks. I don't chase hype. And I absolutely do not invest in hope. I invest in cash flow, discipline, and durability. If a company can't make money in good times and survive bad times, it doesn't deserve my capital. Period. So when I talk about the two stocks I'd buy in 2026 without hesitation, understand this. These aren't lottery tickets. These are machines. Machines designed to produce profits year after year. Cash flow matters more than hype, because hype is temporary and money is permanent. Markets can get excited about stories, trends, and promises, but excitement does not pay dividends, buy back shares, or keep a company alive when conditions turn ugly. Cash flow does. A business that consistently generates real cash has options. It can invest in growth, survive downturns, reward shareholders, and negotiate from a position of strength. A business fueled by hype has none of that. It lives quarter to quarter, dependent on sentiment, headlines, and cheap capital. And when those disappear, so does the illusion of value. Hype thrives in good times. When interest rates are low and money is easy, investors are willing to believe almost anything. Future profits are pulled forward, losses are ignored, and valuation stops making sense. Companies with no earnings suddenly become disruptors, and burning cash is reframed as investing in growth. But cash flow does not lie. It shows what is actually left after the bills are paid. It reveals whether customers truly value the product enough to pay for it today, not in some distant future. When markets tighten, the difference becomes brutal. Companies with strong cash flow slow down, adjust, and continue operating. Companies without it start cutting, borrowing, or issuing more shares, quietly diluting the very investors who believe the hype. Cash flow gives a business control over its own destiny. Without it, management is forced to answer to lenders, investors, and markets that have no patience when fear replaces optimism. Cash flow also enforces discipline. When a company knows it must generate real money to survive, it thinks carefully about costs, pricing, and efficiency. Waste is harder to justify. Bad ideas are abandoned faster. Profitable customers are prioritized over flashy growth metrics. Hype-driven companies do the opposite. They optimize for appearances. They chase user numbers, buzz, and headlines while ignoring whether the underlying economics actually work. For an investor, cash flow is proof. It is evidence that the business model functions in the real world. Revenue can be manipulated, earnings can be adjusted, and forecasts can be polished, but cash flow shows what truly enters and leaves the business. It is the difference between accounting success and economic success. Over time, markets always return to this reality, no matter how exciting the story once sounded. Cash flow also creates resilience. Inflation rises, rates change, consumer behavior shifts, and competition intensifies. A company producing steady cash can absorb shocks that would cripple weaker businesses. It can raise prices, improve margins, or invest in innovation without begging for external funding. Hype offers no such protection. When conditions change, hype collapses instantly because it was never built on a solid financial foundation. Investors who prioritize cash flow are not trying to be clever. They are trying to be right. They understand that wealth is built by owning businesses that generate surplus money year after year. This surplus compounds, funds expansion, and rewards patience. Hype promises speed, excitement, and extraordinary returns, but it rarely delivers durability. Cash flow delivers durability, and durability is what turns investing into a long-term advantage rather than a repeated gamble. In every market cycle, the same pattern repeats. Hype attracts attention first, then capital, then disappointment. Cash flow attracts skepticism at first, then stability, then respect. Over decades, the winners are always the companies that quietly produce money while others chase applause. Investors who learn to ignore noise and follow cash position themselves on the side of reality, not fantasy pricing. Power protects profits because it gives a business control in a world where almost everything else is uncertain. Costs rise, supply chains break, currencies fluctuate, and consumer preferences change. But a company with true pricing power does not have to absorb all that pressure. It can pass higher costs on to customers without losing demand. That ability separates fragile businesses from durable ones. When margins are protected, profitability remains intact even when external conditions become hostile. Most companies do not actually have pricing power. They compete on price, discount aggressively, and live in constant fear of losing customers to the next cheapest alternative. Their margins are thin, and any increase in costs hits them directly. A small rise in labor, energy, or raw materials can wipe out profits entirely. These businesses survive only when conditions are perfect. The moment the environment changes, they struggle because they lack leverage over their own economics. True pricing power comes from differentiation and necessity. When a product or service is deeply embedded in a customer's life or business, price becomes secondary. Customers stay because switching is inconvenient, risky, or emotionally uncomfortable. This creates a moat that competitors find hard to cross. The company no longer sells just a product. It sells reliability, status, integration, or peace of mind. That is what customers are really paying for, and they are willing to pay more for it. Inflation is where pricing power reveals its full value. When prices rise across the economy, companies without pricing power see margins collapse. They are forced to choose between raising prices and losing customers or holding prices and losing profits. Companies with pricing power do not face this dilemma. They adjust prices gradually, often without significant backlash because customers perceive continued value. The brand, the ecosystem, or the switching costs justify the increase, and profits stay protected. Pricing power also strengthens long-term planning. A business that can confidently raise prices has visibility into future cash flows. It can invest in innovation, marketing, and infrastructure without guessing whether margins will survive. This predictability attracts better talent, lowers risk, and improves execution. Businesses without pricing power are constantly reactive, cutting costs, and delaying investments, always one bad quarter away from trouble. From an investor's perspective, pricing power is one of the clearest signals of quality. It shows that the company is not easily replaceable. It indicates customer loyalty that goes beyond convenience or price sensitivity. Over time, this translates into higher returns on capital and stronger compounding. The market may underestimate this advantage in the short term, but over years, pricing power quietly drives superior performance. There's also a psychological dimension to pricing power. When customers accept higher prices without resistance, it reinforces the company's position and confidence. Management gains flexibility. It can focus on long-term value creation instead of constant price wars. Competitors, unable to match the same pricing, are forced to sacrifice margin or exit the market altogether, further strengthening the dominant player. In difficult economic periods, pricing power becomes a form of insurance. Demand may slow, but profits do not collapse. Revenue might fluctuate, but margins remain healthy enough to sustain operations and shareholder returns. This stability is rare, and it is why businesses with pricing power tend to outlive cycles that destroy weaker competitors. Over decades, companies with pricing power steadily pull ahead. They grow not just by selling more, but by earning more on what they already sell. Each price increase compounds the value of the business, reinforcing its moat and profitability. Investors who understand this focus less on short-term sales growth and more on the ability of a company to control its own. Pricing destiny recurring revenue wins in uncertainty because it turns unpredictable markets into manageable systems. When revenue repeats automatically, a business is no longer dependent on constant selling just to survive. It gains visibility into future income, which is invaluable when economic conditions shift without warning. While one-time sales spike and collapse with consumer sentiment, recurring revenue creates a baseline that allows a company to plan, invest, and operate with confidence even when the environment becomes unstable. Uncertainty is where most businesses fail. Demand slows, customers hesitate, and spending decisions are delayed. Companies built on transactional revenue feel this immediately. Each month starts at zero, forcing teams to fight for every dollar again and again. In contrast, recurring revenue businesses begin each period with a large portion of income already committed. This reduces stress, stabilizes cash flow, and lowers the risk of sudden financial shocks. Recurring revenue also changes the relationship between a company and its customers. Instead of a single transaction, the focus shifts to long-term retention. Value must be delivered continuously, not just promised upfront. This creates alignment. The company succeeds only if the customer continues to see benefit over time. As a result, products improve, service quality increases, and customer experience becomes a priority rather than an afterthought. From a financial standpoint, recurring revenue improves predictability. Forecasting becomes more accurate. Budgets are based on real commitments rather than optimistic assumptions. This predictability lowers operational risk and makes the business more resilient. During uncertain periods, predictability is often more valuable than rapid growth because it allows leadership to make informed decisions instead of reactive cuts. Investors value recurring revenue for the same reason. It reduces volatility. Businesses with stable, repeat income are easier to evaluate and less likely to deliver negative surprises. This often results in higher valuations over time, not because the business is exciting, but because it is reliable. Reliability compounds. Each retained customer adds to the future revenue base, strengthening the foundation of the business. Recurring revenue also creates operating leverage. Once the infrastructure is built, adding new customers increases revenue faster than costs. Over time, margins expand as fixed expenses are spread across a growing base. This is especially powerful in uncertain economies where cost control matters. A company with recurring revenue can slow customer acquisition spend without collapsing because existing customers continue to pay. Churn becomes the central risk, but it is also measurable and manageable. Unlike unpredictable sales cycles, retention rates provide clear signals. Management knows exactly where to focus improvement efforts. Small gains in retention can dramatically increase lifetime value, reinforcing profitability without aggressive expansion. This efficiency is crucial when external conditions make growth harder and more expensive. Recurring revenue also offers strategic flexibility. Companies can experiment, innovate, and adapt without risking immediate survival. They can introduce new features, adjust pricing models, or enter new markets while relying on a stable core. This adaptability is what allows recurring revenue businesses to evolve through economic cycles instead of being destroyed by them. During crisis, the advantage becomes obvious. While transactional businesses scramble to replace lost sales, recurring revenue companies focus on protecting their base. Even if growth slows, the business remains operationally sound. Employees stay productive, investments continue selectively, and competitors without this stability are forced to retreat. Over time, recurring revenue transforms uncertainty from a threat into a manageable variable. It does not eliminate risk, but it smooths it. Instead of dramatic highs and lows, the business experiences gradual shifts that can be addressed with planning and discipline. In markets defined by volatility, this steady rhythm becomes a competitive edge that few models can match. Dominance creates stability because control over a market reduces dependence on unpredictable forces. When a company holds a commanding position, it shapes the environment instead of reacting to it. Competitors adjust their strategies around the leader. Customers build habits around its products, and suppliers align their operations to meet its standards. This central position lowers uncertainty and creates a level of predictability that smaller players can rarely achieve. Dominant companies benefit from scale, and scale absorbs shock. Fixed costs are spread across massive revenue bases, allowing margins to remain intact even when demand softens. Marketing, logistics, research, and infrastructure become more efficient as size increases. While smaller competitors struggle to remain profitable during slowdowns, dominant firms continue operating from a position of strength, often using downturns to gain even more share. Market dominance also influences pricing behavior. Leaders are less likely to engage in destructive price wars because they do not need to. Their position allows them to maintain rational pricing, preserving profitability across the industry. Competitors who attempt to undercut prices often discover that they cannot sustain losses long enough to force meaningful change. The dominant firm outlasts them, reinforcing its position without sacrificing margins. Customer behavior plays a critical role in this stability. When a company becomes the default choice, customers stop actively evaluating alternatives. Familiarity, trust, and convenience replace comparison shopping. Switching becomes a risk rather than an opportunity. This inertia stabilizes demand and reduces volatility in revenue, particularly during periods of economic stress when consumers prefer certainty over experimentation. Market leaders also attract better resources. Talent wants to work for winners. Partners want to collaborate with platforms that matter. Capital flows more easily to businesses perceived as essential. This access creates a feedback loop where dominance attracts resources and resources reinforce dominance. Over time, the company's ability to execute improves relative to competitors, widening the gap and increasing stability. Regulatory and industry influence further strengthens dominant players. Leaders often help shape standards, compliance norms, and industry practices. While regulation can be a burden for smaller firms, dominant companies have the scale and expertise to absorb these costs. In some cases, regulation even raises barriers to entry, protecting established leaders from new competition and stabilizing their market position. From an operational perspective, dominance simplifies decision-making. Leaders have better data, clearer demand signals, and more leverage in negotiations. Supply chains become more resilient as suppliers prioritize relationships with large, consistent buyers. During disruptions, dominant companies are served first, while smaller players face delays and shortages. This operational priority preserves continuity when others experience breakdowns. Market dominance also changes competitive dynamics during downturns. While weaker firms cut back, leaders invest selectively. They acquire distressed competitors, expand capabilities, and strengthen their ecosystems at lower costs. Each cycle leaves the dominant company in a stronger position than before, turning economic instability into a long-term advantage rather than a threat. For investors, dominance reduces the range of outcomes. Upside may be more gradual, but downside risk is significantly lower. Revenue does not collapse overnight. Market share does not disappear suddenly. Stability replaces volatility, making returns more predictable over time. This predictability is often undervalued in environments obsessed with rapid growth. Over extended periods, dominant companies become structural components of their industries. They are no longer just participants, they are reference points. Their stability influences suppliers, customers, and competitors alike, anchoring the entire ecosystem around their presence. In uncertain markets, this anchoring effect is one of the most powerful forms of competitive protection. A business can have shareholder returns are non-negotiable because capital is not charity. When investors commit their money to a business, they are transferring risk in exchange for an expectation of return. If a company cannot or will not reward that commitment, it has no moral or financial right to retain investor capital. Profitable businesses exist to create value, and that value must eventually flow back to the owners. There are many ways companies claim to create value without returning it. They talk about reinvestment, long-term vision, and future potential. While reinvestment can be necessary, it is often used as an excuse to avoid discipline. If a business consistently generates cash but never shares it, management is effectively asking shareholders to trust indefinitely without proof. Real returns remove doubt. They demonstrate that profits are not theoretical and that the business model works beyond projection. Dividends and buybacks impose accountability. Once a company commits to returning capital, it must manage cash carefully. Wasteful spend becomes harder to justify. Overpriced acquisitions are scrutinized more closely. Management decisions face a clear benchmark. Will this create more value than simply returning the money to shareholders? This discipline protects investors from empire-building and ego-driven strategies that prioritize size over profitability. Buybacks, when done correctly, increase ownership for remaining shareholders. They signal confidence in the business and its valuation. Dividends provide tangible income, reducing reliance on stock price appreciation alone. Together, these mechanisms transform investing from speculation into participation in an operating business. Returns become measurable and repeatable, not dependent on market mood. Companies that ignore shareholder returns often drift away from their core purpose. Excess cash accumulates and pressure builds to spend it. This leads to questionable projects, bloated cost structures, and declining returns on capital. Over time, efficiency erodes. By contrast, companies committed to returning capital are forced to justify every retained dollar. Only investments with clear, high returns are approved. In uncertain markets, shareholder returns become even more important. Capital appreciation may stall, valuations may compress, and growth narratives may lose credibility. Cash return to shareholders provides stability and confidence. It proves that the business can generate value regardless of market conditions. Investors are paid to wait, reducing emotional reactions to short-term volatility. There's also a signaling effect. Companies that consistently return capital attract a certain type of investor, one focused on fundamentals rather than hype. This creates a more stable shareholder base, less prone to panic selling. Stability in ownership supports stability in management strategy, reinforcing long-term decision-making rather than reactive behavior. Shareholder returns also force honest capital allocation. Management must decide whether to reinvest, acquire, reduce debt, or return cash. Each option is evaluated against the certainty of returning money to owners. This comparison raises standards and exposes weak ideas. Only projects with compelling economics survive this test, improving overall business quality. Over time, businesses that prioritize shareholder returns build trust. Investors know what to expect. Promises are supported by action. This trust lowers the cost of capital and increases strategic flexibility. When opportunities arise, markets are more willing to provide funding because the track record demonstrates respect for investor capital. A company that generates cash but refuses to share, it sends a clear message. It values control over partnership. It asks for patience without offering proof. In contrast, a company that consistently returns capital shows confidence, discipline, and alignment with its owners. That alignment is not optional in serious investing because without it, ownership becomes symbolic rather than real. Discipline beats speculation every time because discipline is built on rules, patience, and repeatable behavior, while speculation is built on emotion, urgency, and hope. Speculation feels exciting because it promises fast results, but excitement is rarely aligned with long-term success. Discipline, on the other hand, is boring, methodical, and often uncomfortable. Yet it consistently produces better outcomes over time. Markets reward those who can control themselves far more than those who try to predict the future. Speculation thrives on uncertainty. It feeds on rumors, headlines, trends, and the belief that someone else will pay more tomorrow. Decisions are made quickly, often without a clear framework, and justified after the fact. When speculation works, it reinforces overconfidence. When it fails, losses are blamed on bad luck instead of bad process. Discipline removes this randomness. It replaces guessing with criteria and replaces reaction with preparation. A disciplined investor knows why they are buying before they buy. They understand the business, the risks, and the expected return. They set limits, define entry points, and accept that not every opportunity needs to be taken. Speculators chase movement. Disciplined investors wait for alignment. This patience is not passive. It is intentional restraint. Most mistakes in investing come not from what people do not know, but from acting when they should have waited. Discipline also protects against emotional extremes. Fear and greed dominate speculative behavior. Prices rise and confidence turns into arrogance. Prices fall and conviction turns into panic. Discipline creates consistency across these cycles. It forces investors to follow the same rules in both excitement and fear. This consistency prevents overexposure at peaks and emotional exits at bottoms, which is where most long-term damage occurs. Speculation focuses on outcomes. Discipline focuses on process. Outcomes are uncontrollable in the short term, but process is always controllable. A disciplined process does not guarantee immediate success, but it dramatically improves the odds over time. Speculation relies on being right quickly. Discipline relies on being right often enough and avoiding catastrophic mistakes. Survival becomes the priority because survival allows compounding to do the heavy lifting. Compounding itself is a product of discipline. It requires staying invested, reinvesting gains, and avoiding unnecessary losses. Speculation interrupts compounding by introducing volatility and poor timing. Big losses require even bigger gains just to recover. Discipline minimizes drawdowns, allowing capital to grow steadily instead of repeatedly starting over. The difference over years is not dramatic in any single moment, but overwhelming in total. Discipline also enforces humility. It acknowledges that markets are complex and unpredictable. Instead of trying to outsmart everyone else, disciplined investors focus on what they can control: valuation, risk, diversification, and time. Speculators believe they can outthink the market. Disciplined investors accept that the market does not need to be beaten daily, only respected consistently. Over long periods, discipline filters out noise. Trends come and go. Narratives change. Entire sectors rise and fall. Disciplined investors adapt slowly and deliberately, while speculators react constantly. Constant reaction creates friction, costs, and mistakes. Discipline reduces activity, and less activity often leads to better results because fewer decisions mean fewer opportunities to be wrong. The most successful investors are rarely the most aggressive. They are the most consistent. They follow rules, even when those rules feel uncomfortable. They miss opportunities without regret and avoid risks without fear of missing out. This emotional control is the real edge, not information or speed. In the end, discipline turns investing into a repeatable system rather than a series of bets. Speculation turns it into entertainment. Markets do not pay for entertainment. They pay for patience, restraint, and execution. That is why discipline does not just outperform speculation occasionally. It outperforms it reliably. Over time, discipline always wins because it allows capital to grow without being destroyed along the way.